Hello everybody. Happy New Year. And this is the first 2023 video being shot by the Vermeer Global Fund team. Charlie Fricker and I are back after what was a very difficult year last year for equities. It's been a better start, actually, to markets than a lot of people expected. A lot of pessimism, a lot of views out there that markets would go down, and then in the early part of the year, largely driven by negative earnings revisions, which is obviously something we're going to address here. But it's been a better start to the year. I think that's been helped by the Chinese reopening, their new response to the COVID situation, a significantly milder winter in Europe than was feared. So gas prices have come down a long way, and that's helped to take away worse fears of how bad the recession in Europe might be this winter. So that's been a positive for sentiment, and European, Chinese stocks and Asian stocks have responded pretty well to that. And in the US, I think what we could only term, and what I've seen dubbed by a lot of people as an employment report, along with some other data that was, clearly what we would call Goldilocks, I think, Charlie. And, it might be a good place to start just to update on that and the impact that that's had on markets and, people's thoughts about rates and employment and things like that.
Yeah, I think as you alluded to, consensus going into the year universally bearish, and then we had the first macro data print with being the US non-farm payrolls in the first week of January, which, as you said, I think really was the Goldilocks type report. I think I heard a former Fed official describe it as an immaculate disinflationary report, which I thought sums it up reasonably well. You had jobs growth remaining solid, unemployment sitting still near historic lows, and wage growth starting to cool and starting to come down. So how that reads into the inflationary dynamic. And you look through that report and all the discussion at the end of last year about US entering recession in 2023. Well, if the labour market remains solid, unemployment remains very, very low, wage growth starts to continue to trend down, that US might be able to avoid a recession. I mean, it's amazing to think, isn't it, that all the mistakes the Fed have made over the last 2 years, that if they manage to get out of jail by not going into recession and they bring inflation down, I think it'd be maybe more luck than.
Charlie, to that absolute point, that one of the videos that we shot last year, and we were talking about the idea that the Fed were, raising rates incredibly rapidly and still going for a no recession outcome, and that if they could achieve that, that would be absolutely extraordinary. And quite frankly, I thought there was little to no chance of that, and yet here we are with a lot of discussion about the avoidance of recession in Europe, and despite the significant steepening in rates, and we really don't know quite what's going to happen yet, because obviously those rates just starting to take effect in some cases. But to this point, as you say, employment holding up extremely well. But Charlie, the next thing I think that we've got to focus on, isn't it, is earnings. This is the big issue for a lot of the more bearish commentators. We are starting to see consensus estimates come down. We are just starting to see the beginning of the results season. We had some reasonably good results from airlines, although guidance was cautious, and that could be a watchword for the way we see companies report. We had most of the major banks reporting at the back end of last week on Friday, in terms of JP Morgan, Bank of America, Wells Fargo, Citigroup. They all reported last Friday. Stocks were all higher. Commentary was reasonably sanguine. Buybacks back on the agenda for JP Morgan and Wells Fargo, which of itself is interesting, and them seemingly modelling for a shallow recession in the way they're seeing things, but also admitting that they don't really know what the trajectory of rates are, and it is too early to be sure how the economy and how employment will play out from here, having been so sanguine. But what else are we looking for in this results season as critical as the things that are going to either abruptly end this rally that's got the S&P back to 4,000, or somehow take it on further?
Yeah, I mean, I think just circling back to what the banks are saying about the economy, another data print. CPI was in line with estimates, but the reason I think the market has performed well in the US last week or so was that expectations were for inflation to slow maybe quicker than they perhaps thought a couple of months ago, and you led the market to rally into the data print and had already priced that in. But in terms of earnings, I think we've seen estimates come down, as you alluded to, in 2023. But I think a lot of the sell side analysts will be waiting for this Q4 reporting season before cutting numbers, because at the moment I think we're in around 220-ish priced in for 2022 earnings. I think consensus estimates for 23 are still sitting at around 230. I don't think you'll find many people on the buy side who expect earnings growth in 2023 on an index level. So we expect those numbers to be cut. It's just a question of where they get cut to. Do they fall at that kind of 208, 210 level, which I think is where most people would see as a good result, or down to some of the more bearish estimates that I've seen in the market of sub $200 of earnings this year. But we'll find out over the next month or so. I think, as you alluded to, the banks were pretty solid, all things considered, and see big tech coming up towards the end of January with all the mega caps reporting. It's been interesting over how that's developed over the course of 2022 and into where we are now. That I think last reporting cycle, most of them put up tricky quarters, which generally disappointed, and a lot of them saw their shares down 5 to 10% on the day of the numbers. But on the same day, the index actually performed okay, and in a lot of cases finished higher, despite these constituents falling quite sharply. I think it's a combination of two things. One, maybe they're not as important as for the market overall as they perhaps were, because they are smaller parts of the yes, they are still a big parts of the benchmark, but they're smaller than they were 12 months ago, because they've all had difficult years for various reasons. Concerns about the slowdown in growth, especially amongst the cloud relating to AWS and for Microsoft. So seeing how Azure and AWS perform this quarter will be very important. But also you're seeing a lot of cost-cutting announcements from these companies, and the degree to which they'll be able to cut costs, how fast they can do it, is going to be an important theme to look out for in 23, because these companies have had a superb run over the last 10 years or so. And they're a lot more established, bigger businesses now than they were during the last downturn. And monitoring their ability to cut costs, how quickly and how well they can do it, is something that I think is going to really drive where their earnings shake out over this year. So I think that's something that we'll continue to monitor. And how the stocks react, I'm not sure, because they've all had tricky years, as we've talked about. Where the sell side estimates are versus where the buy side's sitting, I think are quite different. And I think on a market level, you could say that the buy side's well ahead of where the sell side estimates are. So that'll be interesting to see it play out. And as you kind of mentioned earlier, it was the UK retail stocks that put out their Christmas trading statements. A lot of them were very, very solid, and the stocks didn't really do very much, I think, because a lot of that had already been priced in. So that's all going to be very interesting things to monitor. But the big, I suppose, the thing that we're monitoring, I think, is important on a macro level for the market, because of the potential ramifications globally to any changes that might be made. We saw some allusions to this in December, was what the Bank of Japan might do this week with their policy, and we'll probably have to do a separate video, I think, on depending what the outcome is, the meeting later this week.
Well, that's definitely right, because obviously Japan has been quite central to our strategy over the last 6 years, and we have been not necessarily positive about the economic backdrop in Japan, but very positive about the quality of some companies there, about valuations in the overall Japanese market, the activist investors becoming more involved, far better, more shareholder-friendly environment there, attitude from companies, and sort of seen that as a good cocktail for investment. And actually, whilst it's been a bit more difficult the last couple of years, the first 4 years, that worked pretty well for us on an individual stocks basis. And last year some of our stocks got caught up in the growth sell-off, and then of course the yen disintegrated, so none of these things were helpful. And then lo and behold, at the end of the year, completely unexpectedly, the Bank of Japan made the first adjustment, didn't they, to their interest rate position, raising the sort of threshold from 0.25 to 0.5, and catching everybody offside, because everybody had been universally short the yen all year. And of course, there'd been nothing happening in bonds. And so it's going to be a real test to see what happens next. And, as you say, I think that, the logic is that we'll see what they say tomorrow, and then we will follow up with some further observations as what we think that means for our strategy within Japan, whether that leads to any change in policy, and actually whether it has any further more far-reaching implications for markets as a whole. Things like gold have been very good on the back of it. The dollar's been weaker. Some of those things have already played out to a degree. So it'd be very interesting to see if there is further action taken this week and how markets respond to that. And we will get back to investors to follow up on that. So it's going to be a busy week with results season really kicking into gear again, and the Bank of Japan news flow. And then, as always, of course, we're all on Fed watch permanently. We're all on inflation data watch. And, company comments about wage inflation that they're seeing and raw material costs and, what's turned from a headwind to a tailwind on freight costs and things like that are all going to be important things in the mix alongside the individual guidance that companies give, with their results. So there's going to be lots to focus on in the coming weeks. So we will certainly be getting back to investors with a follow-up video on that in the next week or so. So we'll leave it there for today. Thanks very much indeed for your time, Charlie, as ever, insight into all things US in terms of the data. Look forward to catching up with investors. Just as a quick reminder, Vermeer runs a global long-only fund, roughly 60 stocks, goes anywhere and everywhere in the world, obviously including places like Japan and Singapore, and takes a very keen interest in the macro overlay to the way it selects stocks. So all these things that we're discussing are very important to what we put together by way of our portfolios going forward. So thanks for your time, everybody, and look forward to catching up with you again very soon to discuss further some of the things that we've touched on today. Thanks very much.